Okay, hello, folks. Welcome to State of the Market. I'm David Russell, Global Head of Market Strategy at TradeStation. It's great to be with everyone. We'll start with a few quick disclosures. And some of these market conditions now seem to be entering some real change, and we're going to be covering that. Um, and I think there are fundamental things and technical things that are giving us a different kind of picture than we've had for the last 12 to maybe 16 months. It is interesting to think back. I remember when we were doing our market trends at the time, we talked a lot about that moment in November 2023 when things changed very quickly in a positive and dovish direction. And it's hard to believe, though, that was more than 12 months ago. So these are standardized returns of some of the ETFs we may be talking about and will be talking about some of them. And we also shared the link to the prospectuses right there in the chat. You can see these standardized returns. But I think it's important to realize that that moment of dovishness and optimism and all that that started really in November of 2023 when we had the revision, a positive, a good deflationary revision to the unit labor cost. That was when it all started. That's now what, 14 months ago. So I mean, no more than that, 16 months ago. So you get to a point where the bull run we're in is not young anymore, and we might be starting to see some signs of you know things suggesting it might be nearing kind of not, you know, maybe more towards the end, at least some kind of fading here. And there are various things that are now emerging. And so we're going to be going through those. Um, but I would say here, the first thing I want to point out, we're looking here at just the performance of the spider funds. We're going to jump to trading view in a second, but I want to first start off by showing you here that if we look these spider funds here, if you look in the last month, consumer staples are the top performing. That is not consistent with a bull market. Our top underperformers are consumer discretionaries, industrial, and tech. So, I mean, communications have been strong. You have the mega cap, which is basically XLY, XLC, XLK, and of the three, two of the three are lagging the S&P. So that's kind of interesting. But if you look at the areas that are outperforming, real estate, which we've been talking about, is doing pretty well. Healthcare, another safe haven. Utilities, another safe haven. These have all been doing pretty well in the last month. And I think it's just kind of that is not a sign of strength. I've noticed it very often before a correction happens that you will see a period of XLP outperforming the S&P. And so I think that's just kind of something that we are potentially seeing. And I think it's a potential warning sign to just kind of have on our list. So I wanted to note that. I also want to note that, in our, and we mostly don't look at intraday stuff, but I just wanted to point out that in our market trends webinar, we share this workspace, MTES. I want to mention that it actually gave a potential sell signal this morning before this drop. So this is shared in our market trends webinar, the actual zip file. But the key point is that when stochastic goes overbought and the 50-hour is falling, so stochastic overbought and this oscillator red, that is a sell signal, or a potential sell signal. And today, it would have actually, picked up a drop of about 60 points on the S&P futures. So I just kind of mentioned that was an interesting little thing that I wanted to, highlight, that we do share that. Now, that's on TradeStation. Now we're going to jump over to the big indexes. Now, if you do want to look at some of the stuff that we've done, go to tradestation.com, go to Insights, and on Insights, you'll see we have our article for today. So our Monday article, we often look at kind of the index and the S&P more. So stocks face a potential reversal, and the potential reversal overall, just start very quickly looking at the daily chart. This on the daily chart of the S&P 500 is a false breakout. If you look, we inched up to this high, failed to hold, got above this trend line, failed to hold. So false breakouts are, not a great sign. And if you look, we really haven't done very much on the overall index now for, since Thanksgiving. So, I mean, this is something of a potential sign of things stalling and things kind of, wavering here. I think it's also important to realize that we had these levels back here, back on the 27th. This was a deep seat gap down. We bounced. Then we had the tariff gap down and bounce. And, if we kind of break that level around 59.63, that kind of ballpark, depending where exactly you want to draw it. There was also this line here, 59 kind of 73. that went back to the Friday of Christmas week. There's an area across here. The thing is that if this kind of breaks, people might see significant space here. And I think that multiple charts have this kind of space on them. And I think we just need to realize that that is something now that is kind of becoming a risk. And I think we need to kind of just realize that it's there, because I think a lot of people might be looking at that space on the chart, and they might be also kind of just wary of what happens if things don't hold here. So I wanted to kind of note that, because I think that's like kind of the big story about what we're looking at today. So I would say that right now, the bigger thing, as we kind of start looking at the index of the S&P 500, you can see now we're in the weekly chart of the S&P, you can see the same thing. But I first want to just mention some of the overall things that are here that I think are, have to be kind of considered, or just kind of bear in mind, is that the S&P is trading at more than 20 times earnings. Most of the long-term valuation models that you look at would say the market is relatively expensive here, or extremely expensive, depending on how exactly, which model you look at. Warren Buffett has a record amount of cash, and there's more and more people saying, kind of cautious things about the market. So we're at a spot here where the market with this uptrend is about, 16 months old. And people are starting to say things that are, like Warren Buffett has cash that he's not putting to work. Today I saw something from the guy at Apollo, something, I can't remember his name, Torsten Slock, I think is his name, who was making notes about how the economy might have issues. There are different things that are now kind of, not as Ken Griffin was saying some things about the impact of tariffs and all that stuff. So there are some things here. We're getting some evidence that confirm that could potentially confirm negative reads. And I want to just kind of point that out. We're seeing it technically and we're seeing it fundamentally. But I think it's important to realize that it's happening in a context of high valuations, which means there's less potential margin for error. And I think that's an important thing to realize. Excuse me. So basically, we're in a spot here where things are at high multiples, and that might actually create more risk of things kind of crumbling. People might not want to give the benefit of the doubt. You go back to November 2023, the market had been pulling back for months. It had pulled back the previous year. It was still below its all-time highs. Now we're at a spot where that kind of value argument is not as strong as it might have been. And I think the other thing to remember is that we are starting to see evidence of multiples getting cut, not multiples, I'm sorry, estimates. There are signals out there of earnings, forward earnings estimates getting cut. Now remember, we entered this year expecting 3 consecutive quarters of double-digit earnings growth. Q4 we got double-digit. Q1 that we're presently in, people were looking before around 12%. Now it's come down a lot. I don't have the updated figures from last week, but the thing is, there's a lot of evidence now that those have been getting trimmed. There have been multiple people putting notes out on that. So again, 20 times earnings might make sense if you're growing double digits, but what happens if that growth slows down or gets pushed out? The multiples get harder to justify. So that's, I think, another important thing to kind of realize. Another big thing today was it's emerged. There was a report from TD Cowen that Microsoft is cutting its capex, canceling some contracts with certain data centers and things like that for cloud investment. Now, again, Microsoft kind of made some kind of issue of argument rejecting it or denying it or something. And I think these are all the sort of things though, where it's like exactly what Microsoft did is in some ways less important. The fact is, you get to a point when a trend has been going for a long time, and then you start to just have evidence of it kind of slowing. And when things are on these margins, it's like this is kind of what it looks like, where it's like the information starts to turn a certain way, and that can often, when you look back at it later, say that was the real kind of warning sign. And so I just realized that these things are now kind of potential warnings, but we're getting, actually quite a few of these potential warnings. If you look at our article here, we document, this was unusual. And I've written a lot of articles in my time of, hard to believe, more than 25 years now. I've been, covering, finance and stuff like this, as a reporter and an analyst. And essentially what I see here is this is unusual. The chorus of negativity that we saw last week in substantial data. S&P Global, they were looking at real data. They said prices are rising and orders are falling. I mean, this is interesting. And then we also had the National Association of Home Builders extremely negative. They said that basically people want to build less and they're less likely to lower home prices. They're less inclined to lower home prices because of uncertainty. So we're actually seeing a stagflationary narrative emerge. The consumer sentiment was very bad. If you also look at the data we got just today from the Dallas Fed. Now, remember, these are all February numbers. A lot of the data, January or even a previous month. Um, but this, my computer just did something strange. Hope you guys are still with me. I apologize. I don't know what it was. It was like it froze for a second. I'm probably not the only one, but my computer, I think, updated to the newest version of Windows, and it's been doing some strange stuff. So anyway, I apologize for that. Anyway, all the data we're getting is February. That's the key thing about these numbers. A lot of the other data you get, like the inflation numbers, remember, those are January numbers, so they matter less in some ways. The most recent up-to-date data we're seeing now. So I think we also have to realize people are going to be looking out. They're going to be looking at that, initial jobless claims this Thursday. That could be telling us something about where we are in terms of the economy. So I'm going to get to the index in a second. I just want to point out there are multiple points here that are pointing in a negative direction. It's even interesting to look at things like Domino's Pizza had, weak consumer, weak comps, and that's, a widespread kind of consumer, company. Lamb Weston, which they sell potatoes to basically restaurants, but I mean they are a big one in the food service industry. They've been struggling. So again, things like restaurants, and those are a leading indicator of consumer sentiment. Retail sales were actually quite bad and surprisingly bad in January. The consumer sentiment's been weakening. We have just a lot of these things right now that I think we have to realize that people are starting to say, you know what, maybe the economy is going to have issues. And I think we have to also realize is for a long time, we have had the cyclical parts of the economy like manufacturing, construction, those sort of areas. Professional services have not been positive at all. All the strength has been coming from healthcare and things like that. So there's an argument here that the cyclical parts of the economy were already kind of struggling, and then you throw in all this stuff we saw from S&P Global with the PMI data and all this other stuff, and you can start to put together a narrative of things maybe kind of starting to slow here. So I want to just kind of point that out. And also, there's some other things you want to check out this article, like about the cruise ships and stuff like that. I don't want to get into, but there's been a lot of worries also about defense spending. I mean, these things push aggregate demand into the economy. And, we start talking about things like defense spending or uncertainty about that. What does that do? I mean, these things trickle through the economy in various ways. And so I think that's an important thing to realize. All right. So, I mean, the one thing, other thing is just kind of interesting. You can have a phenomenon in the economy when, like, if you're a business leader and you start to think things maybe get worse, or I don't know what tariffs are going to do, you can kind of have a collective sort of, freezing up of people not wanting to take risks, not wanting to invest, not wanting to hire, things like that, looking to cut costs. That can then turn around and turn into a sort of cascading of economic weakening. And the fact is, we have seen a fair bit of evidence that might be starting here. And I think we just have to realize that. This report from S&P Global last week was kind of stunning. You look at the stuff Ken Griffin said, it was kind of jarring. And you put these things together and some of the other stuff out there, we are starting to get some evidence of a sort of coordinated panic potentially emerging. So I want to just point that out. Those things are there, and then we go back to the S&P 500, and we see that we're trying to cling to this level. So the only point I'm saying is people might want to just kind of realize here is that, given this environment, it might be something people say, you know what, maybe we need to go back to these lows under 5,800. And that's, I think, the key thing here is. So the key point is we have a level, we actually have a zone. The zone, I gotta see that. I like too many charts. Right? So basically, we have a zone between 60, 15 on the daily and 60, 23. And there's various places this goes back to. It goes to this weekly high on the 17th of January is the bottom of that. And then the November 29th weekly close at 60.32. So this level, it was interesting to see how it became support in multiple ways. And we talked about this at the time, so I'm not going to get back into it. But the key thing is this zone between 60, 15 and 60, 23 has been relevant really for this market since December. And now, I mean, the risk is if we crumble back through it. It's also right by the 50-day moving average. So I think we have to realize here that there is some risk of things kind of crumbling. And if these levels don't hold, then people might be looking, I mean, to me, like this low, it's like we got pretty close to it. But the thing we might want to realize is, if we break here, this low is held, but that third time we touch it, it might not really hold. And people might be looking closer back down to these levels to go back to that election day. So I just want to point that out. This is something it's on my radar. And I'm probably not the only one. So that's what I'm saying here in the S&P. I'm going to mention about this level is that basically this level across here that had kind of worked for a while, that we had bounced that around, which was the Christmas Friday close, that area, the next time we come to it, it may be a little bit less clear because it's kind of in the middle of a range. And when things start going, you kind of look for the extremes of the range. If volatility starts increasing, we can see an expansion out the range, not looking for this tight things to hold inside of the range. So all this is inside of the range, and people might say we got to go to the outside of the range. So that's what can often happen when volatility increases. So that's the S&P 500. Let me also just point out, if you look at the daily chart, there's multiple things that are kind of weakening here, of like MACD, or I don't have them on this chart, but a lot of the oscillators are kind of pointing in a weak way. All right, so let me get to the QQQ, the Qs, and basically on the Qs here, we're also trying to kind of hold a similar level, and then people might also see this kind of downward sort of space. So I wanted to mention that right here, this level down toward, um, in this case, it'd be down, if we, if that 520 level does not hold, people might be looking at something much closer down to 501. So, I mean, again, there is some space here. We're lingering up here trying to hold this higher support level. Now, of course, remember, NVIDIA reports on Wednesday afternoon. So that is a major catalyst here for what's happening in tech. It could be also something where if people are bearish, they might wait for that NVIDIA event, and then that will cause liquidity. And that could be the time when the big activity starts. So this week could be hanging and waiting for that NVIDIA event. I want to just point that out. Now, in the Dow, we had talked about the Dow forming this double top and the fact that it really was failing to have weekly closing highs, and that did kind of translate into a break, to the downside here. So I think when we look at the Dow, the DJI, we can see here that this maybe does have, this is also kind of trying to hold on here. And again, it has some potential space here. So this is in a similar sort of spot. The fact that this thing failed to break out is also, I think, something people have to be kind of wary of. Now, the Russell is kind of the weakest of the bunch. And from my point here, I'm looking at a spot here where this is now something where if you even look at this level from back here in early February, right around, 20, 2243-ish, this kind of level on the Russell is basically that it was like the weekly open, and then it was the low. Those first 2 weeks of February, the first 2 full weeks of February, and then we just ripped right through that. So I mean, here we are trying to hold a level, and it was a level going back to no, October, but this is the one that has been, that it failed to get it. Remember, it's the only index that failed to go to a new all-time high. Well, it did by a fractional amount before it got rejected back there in late November. So I mean, this is in many ways remains technically the most damaged of the major indexes, and so this had a false breakout. It has basically stayed the farthest from its highs, and so this is, I think, one here that just looks. I mean, when you look at it, this one has the most kind of warning signs. And so from my perspective here, this might be one that people could be looking about. This level down to the low of the week beginning September 9th, down to the low here of August. This might be a space people look for. So basically the low of September versus the low of August, people might actually be looking down into that range on Russell. All right, the TNX, the 10-year, we had kind of mentioned the languidness of what's happening in yields here. And I think it's important to realize here is that if we do get a kind of panic sort of situation, this could be something where if things do get bearish, this could be something where people look for this to push to the downside here. I think people have to realize that, the market has not seriously considered or even discussed the possibility of a recessionary trend in a long time. Even the notion of recession in many ways has not been in play since COVID. I think we have to realize that. I mean, there might have been a few times when it was slightly out there, but all of our fear and all of our risk has been in terms of the economy being too strong. But the thing is, when you start talking about large layoffs and all kinds of stuff like that, you start talking about cutting government spending in uncertain ways, suddenly the GDP question comes into play, and the idea of a cyclical weakness comes into play. And when that's the case, and you get treasury yields here that are relatively high in a long-term sort of thing, if you're a long-term treasury investor and you think, wow, we might actually be looking at payrolls going sub 100,000, we might actually see unemployment going higher. Treasury yields here are pretty close to their 15-year high. So people might actually say this is not a bad place to be putting on duration, so to speak, in terms of buying bonds, in terms of looking for yields to move lower. And so I think that that is a little bit of the narrative that's taking shape here. So I think that's another way to think about it. And as much as you might talk about inflationary stuff and everything like that, of tariffs or anything else, if we get into a spot here where the cyclicality turns weak, there are areas. I mean, I think the argument in favor of bonds will become more powerful. I would also mention that things like consumer staples, real estate investment trust, and utilities, those are all kind of proxies or surrogates for bonds, and they've been outperforming. Those tend to do better in a time of cyclical weakness. They tend to be income stocks in there. If you go to your 401k and you look, I mean, these things are not many people even use like think of income investing anymore, but income investing is focused on that idea of dividends and yields and all that sort of stuff. And so the thing is that the income stocks like utilities, real estate investment trust, and consumer staples have been doing well. Those are a leading indicator often for bonds. I think it's just important to realize that. So I think right here, people might be actually looking for the 10-year, in a scenario of the market getting weak, this could be something where people look for this break, and there could be a potential jump in bond prices in that environment because we've been trying to, the yields would move lower, the prices would move higher. So I think people have to realize here is that bonds have gotten stuck here pretty good and they're just kind of stalling, and people might be looking for a move back closer toward 4.1 on this thing. So, and in fact, if you look, that kind of goes back here. So I want to just kind of, in fact, we used to have, no, we had it marked up down here. We used to talking about how when it cleared this, and this was way back in like October, when it cleared this level, we noticed how the upside was in play. But now it's just kind of the opposite. These candles here, there's no ability for yields to move higher. All right, now materials here. From my view, there's been, also an area where this is basically had this kind of bounce that's hitting resistance. So, from my view, if you're talking cyclical weakness, this is now setting up in a way that the bears might really like what they see. Essentially, let's go to the daily on this thing as well, because in the daily, you got the 50-day moving average is like falling down across here, and it's like tried to rally and like failed and everything. So from my perspective here, if you look on the daily, this intermediate trend might be the thing that really dominates price action in this. And if you look here on the weekly, you can see we have space down like a good, from 89 down potentially toward 83 on this. So I mean, people don't trade materials that much. So I think it's important to realize they're highly cyclical, and a lot of them have also bounced on kind of optimism about steel tariffs and everything else. But that kind of giddiness based on hope um, often does not last when people start to talk substantially or substantively about a recession and layoffs. Things like materials could really struggle in that environment. So I want to kind of mention that here. This is something where it's stuck at resistance and it might have space to the downside. It made a lower high, and I'd honestly say, that level might be in play, but we made a low, a lower high. That might actually mean a lower low could be something people might think about under that level. And I'm not sure where that would be, but I did want to just point that out because this might be something people actually see the potential for a lower weekly low to follow the lower weekly high. Now, communications XLC continue to hold this area, but they're very tight up at a level like this. And the problem with tightness is if volatility does increase, if selling does come into force, tightness turns into wideness and volatility takes over. So I think we have to realize this level, if it breaks, I think people could start to really step in. And there's obviously a lot of people who've made money in things like Meta and the overall, communications names. There's a lot of, you know, money that could potentially come out of it quickly. So I think people have to realize that, people might be looking for something of a relatively quick move down toward these January lows if things do break. So I don't want to be overly bearish. My point is overall is that I'm just saying these are all potential things that are out there, and we don't really have that clear confirmation yet. The market is just kind of sitting and stalling. Last week when we did market trends, we said basically if we get under 6101, then we're going to get the risk of getting sucked back into the range. And if you look back on the S&P 500 back when we did that on Thursday, you can see here we were talking at that time, and we said if we get under 6101, then things are problematic. And you can see once we really got under that old high, which was I'm not sure anyway, there was a on a different chart we had it marked up, but the key thing is once we really got under 6,100, it was a pretty quick move to 6,000 here. So I think the thing is we got sucked down the range. It's a false breakout, and we got sucked back into the range, and that is not a particularly good situation to be in. I mean, look at something like XLC, you could say the same thing. If this thing gets back under the high of December, then we get sucked back down the range. And then there's a lot of people who have probably been sitting on significant profits in things like Meta and also probably have long-term capital gains. We're in a new calendar year. So people can like potentially be selling things like this. And I think, these are areas now where no matter how good Meta might be, it is in an area where people might actually start to say, if I've been in it for like 18 or 24 months, then, there might be some risk in something like communications. I want to point out, yes, we're holding this level, but there is potential here for if volatility comes in for this tightness we've seen to turn into something more kind of volatile. All right, so now energy here remains in this kind of tight range. I think the thing about energy that's important to realize is that the global economy is actually showing some signs of, kind of improvement and optimism. And the other thing about energy is it trades at such a low multiple, the energy stocks, that I think it actually creates some sort of, people who are disgusted with paying really high multiples or growth stocks, can look at something like energy. So I think we're in a little bit of a spot here where energy stocks might actually have a little bit of, some kind of strength here. There is this kind of converging triangle. I would look for, something like 90. A break below 90 could, make this look like it's basically like a failed upturn. I think at this point, energy is pretty neutral. And I think that people get fearful. People want to think about things not being great, and they start talking about stagflation or anything like that. Something like energy is something that, it might actually have a certain kind of philosophical appeal. And at this point, it really is in this triangle. So I want to kind of point this out. And in my view, it doesn't really have any kind of clear, signal or opportunity. Now, financials have also been very strong. Now, financials are not as prone to tariffs as something like industrials are, but they're also trying to hold a tight level here with some significant space down. And they are also, of course, highly cyclical. We also had a bearish outside week last week, potential reversal signal, false breakout, potential reversal signal. So I think right here, financials are something where, these have some potential to maybe, if they don't hold this low around 50.75, then the XLF might have some downside. XLI has this falling channel, and this is now maybe going to be walking down this channel. I want to just kind of point this out. I think industrials here, they have a high multiple. And the other problem with industrials is that they have all kinds of risk to defense spending cuts, and different kinds of government spending is intermeshed with these things. And the other thing about them is that they have varying degrees of tariff exposure. So, I mean, supply chains for manufactured goods are complicated. So they have the cyclical risk, they have high multiples, they have the potential military spending risk, and they also have the tariff risk. So, I mean, from my perspective here, industrials with this falling channel, might be something people look for a move back down the channel, back to 130, or even potentially back down the channel, back to, you could even look back to some of these levels from like back around here that come into play around 125. 126 on the XLI. XLK is very similar to the Qs, where basically it's trying to hold, but you can see this range, and people might be looking in the XLK, this horizontal channel, for things to probe back down to 225 on this one. So I want to mention that. Consumer staples here are, giving this relative strength, and, people might look for a move up toward this kind of high here. I think right now these are an area where, I mean, they're more useful in some ways as an indicator for the overall market. If things do start to get overall bearish, expecting consumer staples to remain overall strong, I think that might not be really what people look for. There's a little bit of a line here. I'm not really sure what to make of this, but I want to just kind of point out that, these are getting up kind of near a high, but the main usefulness of these is that they have given, I think, a pretty strong, potential risk off signal to the overall S&P. Now, real estate investment trusts we've kind of talked about as having, a lot of interesting things happening in them. And, these remain in a sort of tight range here. And if you look at the, the XLRE, there's really nothing here that is especially bearish. They're holding above the 10-day moving average, and probably the 8-day exponential, if you look at that. They've gotten above the 50-day here on the weekly chart. Though what's interesting to me is they've had all these inside weeks and stuff, and they had that false breakdown under the highs from back in January of last year. So we talked about there's this whole slew of positive commentary on real estate investment trusts. How about the office market is finally improved? Obviously, if interest rates go down, most people would consider that a positive for real estate. So it's also doesn't have maybe as much clear tariff exposure or risk. And these guys have absolutely been through the worst kind of punishment with the retail apocalypse, and then offices being shut down and vacancies, and then the Fed hiking rates. And these guys have been basically punished for the last 10 years, maybe 8 years. And so I think there's a spot here where people might start to see some value in them. And I think that's just the thing to kind of remember here is that they do have that kind of potential. They don't have as much of that clear sort of cyclical or AI risk. And they have it, they're in a macro environment where lower yields might favor them. So utilities are in a similar spot. And people might want to just look to see if we can break above this weekly high from late January around 80.44. That's on the XLU. XLV has also had, an attempt to kind of push higher here. And, at this point, it is kind of clearing this downtrend. And I think this is also a non-cyclical area. And if people are worried about the economy and other stuff, this is an area people might look to. So I think here when we look at, consumer, we look at healthcare, people might be looking for some kind of a movement up this range. They might be looking for individual names that are kind of maybe going to, that are maybe showing some strength. I think the sector overall is in a spot here where it's starting to outperform, and it in many ways solves a lot of problems that people are worried about things Doge, and they're worried about things like um, a weak economy or tariffs. And then finally, XLY, we had kind of talked about 2 weeks ago. Last time we did this webinar, we had mentioned that 219.5 area, and that's exactly where we went. And so I think now, people look to hold that, but I think we have to realize is that this is a cyclical part of the economy. There's a lot of other things in here with Tesla and Amazon and everything else, where if things break, people probably can see this entire area to be probed back under 200. And I'm not even sure exactly where that, I mean, I forgot to draw the line. In my view here, the level people might want to be looking toward is this level around not under 201 roughly. Basically the high from back here in September, that could go back. Actually, no. I mean, actually, I'm going to draw it here. I'm sorry. That's where I meant to draw it. So basically 194-ish, the high of July. And then so it also, this has a lot of space on it if things don't work out well. So again, all these things we're holding, we're waiting. Don't want to be like overly like, you know, bearish and leaning in one direction. This is all kind of coming down to some of the warning signs that are potentially developing. But at the same time, we need some kind of confirmation. And the thing like I said at the S&P here is, closing back below this low from the Friday of Christmas week. In some ways, that's, I think, the trigger people will be looking to. And until we have that, we don't really have in that kind of confirmation to the downside. I can sit and wait. We have the NVIDIA event. But the last thing I'm just going to mention is we could get random tweets saying this or saying that. So just realize that those risks are out there. And just looking at the economic events, that might be a hard way to play it. So it could be something where there's a lot of other stuff just kind of flying around at any given moment. So those are things I'm looking at here. And I want to just kind of point out that, that was that false breakout, and I think a lot of people noticed it. So these are the forces, the kind of trends we're looking at in the S&P. We will be back on Friday with market trends. Hope everyone has a great day, and I'll see you on Thursday at 2 p.m. Take care.